Have you ever bought a stock because someone on social media said it would 10x and now you're down 40%? In this video, I'll break down 5 clear signs that you might be investing wrong and what to do instead. Whether you're just starting or have been investing for a while, these are mistakes that even pros make. Welcome to the channel, friends. Markets at the moment are currently at all-time highs. The Nasdaq, the S&P 500, Bitcoin, everything is at all-time highs. But you might find that despite the markets being at all-time highs, your portfolio may not be at all-time highs. And in this video, I'm going to be giving you 5 reasons why you may be investing wrong. Sign number 1, you're chasing tips and hype. And what I mean by that is you're buying what's trending on Twitter, or as they call it nowadays, X, or even YouTube, without understanding the underlying business. I used to do this in 2020 to 2021 cycle, and one of the examples I'm going to give you is this Chinese electric car manufacturer called NIO. This stock here, at the time when I was buying it probably when it's close to $20, and I seen my money go up because at that cycle it did go up to about $60, and I was buying more and more as prices started to go up. However, what happened after that is the price of NIO went down so much, and today it's trading at $4.39. This was a very big lesson that I learned, and at the time there was a lot of hype around this stock, around electric vehicles in general, and I didn't know how to do research at the time, and that's why I fell into the trap in following other people who I felt know better than me. But at the end of the day, if you lose money, there's no one else responsible other than yourself. These people that you followed, they're not going to give you your money back, and they're certainly not going to give you any help as well. So the lesson from this is you need to have some sort of system in place. First of all, if you are going down the route of investing in individual stocks and not ETFs, then you need to know how to pick an individual stock, because not everyone can do that. So to be able to do that in itself is a skill. So it's important to have some sort of checklist or a system in place to identify these stocks. Don't outsource this sort of stuff. Don't rely on other people. Learn how to do it yourself, because if you can learn how to do it yourself and you get it right, you will make life-changing money from it. Sign number 2, paying high fees. And what I mean by this is when you're actually investing, different platforms have fees. And what I mean by paying high fees is when investing, unfortunately, there are fees involved in everything. Some platforms, they charge a fee just to have an account with them. So they take an annual fee of a certain percentage of your balance. So for example, a stocks and shares ISA with Hargreaves Lansdown, which is this company over here, they charge 0.45% every year. So whatever the value of your portfolio is in Hargreaves Lansdown, they just take 0.45% every single year. And at the start, it might not be much, but as over the years, as your portfolio gets bigger and bigger, it can become a significant amount. And I'll show you what I mean by this. This is a compound interest calculator. If I just put some numbers into this, so let's just say every year you can put maximum of £20,000 into your stocks and shares ISA. So I'm just going to use that as an example. And let's just say your goal is to increase your investment by 10% each year, and we compound that every year. And what I'm going to do is every year I'm going to add the full £20,000 because that's the allowance every single year. But for withdrawal amount, I'm actually going to put it as a percentage. So every year 0.45% is what Hargreaves Lansdown charge. And if I put this into here and I use a chart, in 5 years alone, yes, I've made £34,000 in profit, which is really good, but I've paid £1,500 in fees. So that's a very big amount. And if I make this bigger, so if I make this 10 years, for example, you could see over here that my fees now has become £6,000, £6,600 that I've paid over there. You could see that over 10 years, my fees have pretty much doubled to £6,600. And if I make this 25 years now, you could see how that has changed now. £71,000 just to have an account with Hargreaves Lansdown in the long run. And this does not even include some of the fees with certain funds or even ETFs. So for example, the SMH, the semiconductor ETFs, which is built up of a lot of semiconductor companies such as Nvidia, they have an expense ratio of 0.35%, and you can check this on their website. What that means is if you are investing in this ETF specifically, then every year they will take 0.35% as a fee to manage the actual ETF for you. So if you have £100 invested in this ETF, then they will take 35p. But you can imagine if you have a large amount of money in this, then it can become a lot. And imagine that's on top of something like this. So what's the solution to this? The solution, number 1, for the actual account that you use, pick an account that has a very low fee or even zero fees. So for example, Trading 212 here in the UK, if you have a stocks and shares ISA, there is zero account fees. So there's no actual standing charge that you need to pay every single year. So that means over the space of 25 years, you save £71,000, which you can use for other things. Another example that I have is Lightyear. So they don't charge any standing fees for their stocks and shares either. And the second bit is the choice of the ETF. Some ETFs, they will have a high expense ratio and there's not really much you can do about it, but some will have a lower expense ratio. It's about finding an ETF. So what you need to do is you need to look at what your goals are and you need to find an ETF that's suitable for you. So something like the S&P 500, that's a very, very low expense ratio, and that's because it's traded so much around the world that even if they charge a small percentage, they still make a lot of money. But I personally don't invest in the S&P 500, I personally don't have any ETFs in my portfolio, and that's just because of my own personal goals. Sign number 3, no clear strategy. When investing, as with anything generally in life, you need to have some sort of plan in what you're doing. So when you're at school, you need some sort of idea of what you want to do in the future, so you can put your focus more into building your portfolio towards what you want to do. And it's a similar thing with investing. If you want to achieve a certain amount within a certain amount of time, you need to have a game plan behind it. And if you don't know your time horizon, if you don't know your risk tolerance, and if you don't even have a goal, before starting investing, you're probably not ready to invest. You're just guessing. Other people, they'll be buying random stocks, they'll be flipping between growth stocks, dividend stocks, and even crypto just based on how they're feeling or based on what they see online. So what's the solution to all of this? Number one, if you haven't got a goal by now, then you need to sit down, you need to make a goal, and you need to write down what the goal is. You also need to create some sort of plan, at least a rough plan in your head in terms of how you're actually going to get there. What percentage do you need to achieve every year to get there? You can use a compound interest calculator just to get an idea. And the other thing is you need to pick a strategy that suits you. There's no correct way of investing. Some people might invest in lots of small cap companies and some other people might just stick to ETFs or large cap companies, and that's completely normal. As long as you achieve your goals, that's the only thing you need to look at. Sign number 4, no diversification. What I mean by no diversification is if one bad stock tanks your portfolio, you're probably overexposed in that. Diversification doesn't mean buying 50 random stocks. It just means that you need to be careful in terms of how you're actually allocating the money. If your portfolio is £10,000 and you've put £9,000 into one company, that's a very risky thing. That's not well diversified. If that one company goes down, then you're screwed. And the solution to this is not to invest more than a certain amount within a company. So if you're very bullish on Nvidia as an example, then you might say to yourself that, okay, I'm going to put no more than 20% of my own money in Nvidia. So if your portfolio is £10,000, then you already know in the back of your head that £20,000 of your own money is what you're going to be putting in. And if you do feel like buying lots of stocks, but you don't want to do the research, then maybe stick with an ETF and then add any stocks that you feel you want to buy on top of that. And sign number 5, emotional trading. Emotional trading is when you let your emotion take over what you're actually doing. I know of a few people when this tariff dip happened, their portfolios were down so much and they panic sold. And because of panic selling, they missed out on one of the biggest rallies in the S&P 500 since then, and they regret where they are right now. And now they're even thinking about going back into the market because they feel the markets are going to go up. And I've been there in the past. It happened to me in crypto when I seen a lot of cryptos go up and I was just buying more and more and more. And then when I seen crypto go down 30-40% the first time in 2017, then I panic sold. And the thing is, we all learn from it in the end. So what do you actually do then? So if you're a long-term investor, then zoom out. Look at the 5-year, look at the 10-year charts and see the overall trend. And if I do that with the S&P 500, you can see that over the last 10 years, it's pretty much an uptrend. Yes, there's been periods of downturns, such as here, 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 and here, but overall the trend is up. So if you have a long-term view in mind, then these dips, such as what happened in April, they're pretty much the best time to get in. And the other thing I would probably recommend is to use the fear and greed indicator. And if you haven't watched my video on the fear and greed indicator, then click the link above. But this is a very useful indicator where it gives you an idea of what the overall market sentiment is, and currently we're in extreme greed. So for me personally, this is not the best time to be buying large amounts of stocks, because when everyone's greedy, we should be a bit fearful. As Warren Buffett once said, we need to wait till at least fear or extreme fear before we start thinking about putting larger amounts in. That's not to say if your strategy is dollar cost averaging, where you invest every single week, then fine. Investing here is no different to investing over here. But for those that actually want to buy stocks when it's supposedly cheap. This is one very useful indicator. So that's the 5 signs I wanted to go through. If you've made any of these mistakes, don't worry, I have too. What matters is what you do next. Do you learn from it? What lessons do you learn? And how would you do things differently? If you found this video useful, please like and subscribe, and comment below which mistake have you made and what did you learn from it. And if you want to see my portfolio, then click over here.